Hi, my name is Jason Civalleri. I'm an attorney with Horizons Law. We're a boutique law firm that caters pretty much strictly to the crypto asset and blockchain space. I'm also an adjunct law professor teaching blockchain and crypto law at the University of New Hampshire. And I serve as compliance officer for MyCrypto, which is one of the more popular client-side Ethereum wallets. Joining me today is Dave Hendricks. Dave is the CEO and founder of Vertalo, an SEC-registered transfer agent and B2B data management platform that connects and enables the digital asset ecosystem. Dave, why don't you tell us a little bit about yourself?
Hey, Jason, great to be here. Thanks so much, and hey, everybody. So I'm Dave Hendricks. I'm the CEO of Vertalo. A little more than 3 years ago, my team and I got together and we thought about doing an ICO for the first version of Vertalo. We conferred with our lawyers and also one of my co-founders, who's a former SEC attorney. And instead of doing an ICO in late 2017, we decided to do one of the first Reg D security tokens. We issued that security token to 53 holders in March of 2018, right when the crypto kind of, maelstrom had reached its peak. We saw during that process that there was a big gap in the middle. We saw issuance platforms and we saw trading platforms both being stood up. But we didn't see in the middle was a data management platform, like a cap table, like a transfer agent, that would help issuers of digital securities a platform to manage their equity and debt holdings. So we pivoted the company in May of 2018, and we started building the Vertalo that is today. So it's great to be here. Excited to talk about this topic and talk with Dan and you, Jason.
That's excellent. Yeah, sounds like you had some great counsel if they were telling you not to issue what would turn out to be securities in late 2017. That's unfortunate and for a lot of other teams, and it's great you're using that experience to help other projects move forward. We also have Dan Truque. Dan leads business development for Symbiont's alternative assets team. Symbiont is the enterprise fintech company creating the next generation of financial markets infrastructure using blockchain technology. Dan, why don't you tell me a little bit about yourself?
Sure. So as you mentioned, I run business development for the alternative assets team at Symbiont. This is the team that covers private securities, alternative markets, that is collectibles, fractionals, real estate, etc., and also supply chain and logistics. So just a little bit about Symbiont. So Symbiont is a permission blockchain company. So essentially, we're a technology provider that has its own proprietary permission blockchain platform. And we have grown through partnership with very large financial players. So we're talking about companies like Vanguard, NASDAQ, Citibank, Bank of New York Mellon, etc. And the company at this stage is actually 6 years old. The company was created when back in 2013, Mark Smith, our founder, he was actually the former founder of Lava Trading, a huge FX dealer platform sold to Citibank for 350 million plus back in the mid 2000s. He met the co-founders of Counterparty, Adam Carlson and Evan Wagner. Counterparty was actually you could call it the original DeFi protocol. They were putting smart contracts on Bitcoin back in 2012. Anyways, the name actually stems from the symbiotic relationship between finance and blockchain. So we have 4 business lines. The business lines are essentially the teams that use our language and our blockchain to implement a specific solution for our clients. So one is data management, which is the one working with Vanguard for financial index data distribution. That network has been running since early 2019, and it's used daily to rebalance 1.3 trillion worth of assets of CRSP passive funds at Vanguard. We have then fixed income and currencies. This team focuses on on-chain ABS issuance and also automatic collateral management for FX swaps and other OTC derivatives. There was a press release earlier this year about the work with Vanguard and the first, second, and fourth largest custodian banks, which is State Street, Bank of New York Mellon, and Citi, to enable these applications. Third team is mortgages. They have a partnership with Louis Ranieri, the inventor of the mortgage-backed security, to create a massive mortgage servicing platform. And last is my team, which, as I mentioned, is alternative assets, dealing with the private markets and alternative and supply chain and logistics.
Oh, that's great. Well, given you've been focusing so much on how sort of the legacy guard operates things, what do you see are some of the primary differences in the needs for financial infrastructure between the legacy financial markets and those for digital assets?
Yeah, I think like when comparing digital markets with legacy financial markets, which is, it's funny calling them legacy because it's kind of like the current markets. It is what it is right now. It's really like
Hey,
digital
at
markets.
this conference, right?
Yes, exactly. So the legacy financial markets are the result of over almost 100 years worth of regulation and technological advances and limitations that led to the system we have today. So we cannot really throw away all that body of knowledge of all the learnings throughout the time. I think there's a couple of differences that I would like to highlight. And one is that in, let's call it the traditional digital asset markets, and by this I mentioned, it's kind of like the traditional crypto exchanges. When you bring your assets to the exchange, you're actually pledging them to the exchange, and the exchange now holds custody of them. So you have this issue that if the exchange blows up, you lose your assets. That doesn't happen in the legacy financial markets because your assets are held by a custodian. They're never held by the exchange, so there's no exchange risk. And also when you're doing the trades, there's no settlement risk because the trades are guaranteed by a clearinghouse. So all those things are just ways in which the financial markets evolve to provide those safeguards for investors and the integrity of the markets. And those are things that the digital markets are lacking. That said, the current markets, the legacy markets are not flawless. Back in the 70s, as trading started to like speed up, and we hit what was called the paperwork crisis, which was a situation where they even had to take off Wednesday so they could like just carry around all this all the papers to settle all the bonds and stocks that had been traded. So back in the 70s, they created the DTCC as a centralized securities depository that would actually hold all the securities in their name, and then the custodians get a derivative ownership right of that, and then the investor doesn't really own the securities. The custodian owns them on their behalf, and the DTCC owns them on their behalf. So this is called the indirect nominee system. It was something we needed back then because of the issue with the paperwork crisis, and because we didn't like the technology. We lacked the technology. Now that we have blockchain, we actually have the capability of doing two things. One, go back to a direct ownership registry system, because now we have the technology to enable that and get rid of what was supposed to be a temporary solution in the creation of the DTCC. And then second, actually bring all these benefits and reduce risks in the way that called legacy financial markets exist. So I think there's advantages and disadvantages on both sides, and we are at the point where we can actually like bring these things together to create a very robust market.
And it's amazing how the DTCC sometimes takes days to process individual trades, but that's something you see that blockchain can help facilitate much faster.
Exactly.
Gotcha. What is both your take on digital security issuance in public chains versus permission chains?
Well, if I may, Jason, I want to add something to what Dan just said. Dan's comments were mostly related to public markets,
right?
And the way I see digital securities, or the market that we're all trying to develop, as different from the current or legacy markets, is that the legacy markets that everyone complains about are actually highly advanced. Trades occur very, very quickly. They may take 2 days to settle, but they happen in milliseconds. And they're there's a high degree of technology that's been brought to this: algorithms, networks, AI, et cetera. They're very, very modern. The market for digital securities, in our view, in the nearer term, is in the private markets. The private markets are extremely fragmented. There are no marketplaces to trade private assets other than pink sheets or some bulletin boards, et cetera. People complain about public markets taking 2 days to clear a trade. Try clearing a private asset transaction in 2 days. Good luck doing that. More like 2 weeks, maybe 2 months. So there's a huge opportunity to take this technology, whatever you call this technology, I really mean programmable asset technology, and bring it to private markets to reduce friction in the discovery, pricing, purchase and sale of assets across classes and across countries. And what Vertalo is focused on doing is using blockchain, and distributed ledger technology to reduce friction, both in the direct ownership framework, but also in the primary issuance and secondary sale of private assets. I think that, yeah, blockchain will come to public markets when blockchain becomes faster. But today, the private markets are in bad need, sore need of improvements in efficiency. And that's what we help facilitate.
Well, that's a good segue for the next question. What exactly is this technology that we're talking about? And specifically, what is your guys' take on the difference between security issuance on a public versus a permissioned network? And do you see the two ever reaching a point of extensive collaboration, or is one going to inevitably eat the other?
So I think this is one in which Dave and I are probably gonna disagree a bit. Blockchain brings about the promise of openness, collaboration, and transparency, and that opens a world of possibilities. And it's true, like essentially the frameworks that I mentioned bring true value when you apply them to the private markets, because that is where, as Dave mentioned, is where we have settlements that take weeks and not days. And even days in public markets is something that should be fixed, but definitely the low-hanging fruit is in the private markets. Public blockchains definitely have a very good use cases, particularly if you're talking about non-security token transfers. That's what public blockchains are made for. I mean, they have the cryptocurrencies, and you can easily transact these tokens, simple peer-to-peer transactions. The problem is when you start talking about securities. Securities trading in these blockchains have hit several roadblocks. The first one being regulation, of course. As I mentioned earlier, the regulation has been amassed over the past 100 years to safeguard the integrity of the markets and help investors not get pretty much screwed up. So you run into things like the Bank Secrecy Act, where you have like AML and KYC requirements. And because of this type of requirements, in a nutshell, regulators tend to be, let's call it, allergic to public blockchains. So there's already that issue of like, you don't want unknown entities running the infrastructure of a financial entity. That poses a lot of regulatory challenges. However, aside from that, even if you're able to get over that, public blockchains have a lot of issues, a lot of operational risks related to the fact that you don't control the infrastructure in which your mission critical transactions are happening. Forks, rollbacks, unpredictable network fees and congestion. You have what happens if the private keys are lost, governance centralization of miners or stakers, of course, slower performance of proof of work and proof of stake chains, and of course, limited privacy or layer 2 privacy implementations. All these things, some blockchains have worked out, like a few of them here and there, but overall, it's, yes, I guess you could somehow figure out each of these one by one and make it work, but permission blockchains are there and they work and they're faster and they don't have any of these issues and they work in the current regulatory framework. So I just don't see why go through like the complication of trying to do it in a public blockchain, at least right now. And when you look into that, the privacy, I think that's actually where Symbiont's platform really shines, because of the scalable privacy that we can provide to safeguard and be in compliance with all the regulation requirements.
And Dave sounds like he might have a different viewpoint. Go ahead, Dave.
We welcome Symbiont to the Vertalo network. So Vertalo is blockchain agnostic. We actually we don't really care permissioned or public. So we support multiple blockchains now. We recognize and addressed every concern that Dan brought up over the last 3 years. For example, let's go look at self-sovereign wallets. A lot of the issues that Dan brings up are related to self-sovereign wallets like MetaMask. He didn't call it out actually specifically, but self-custodying securities in a wallet which can't be provably owned causes a regulatory problem. Well, we solve that by creating keyless custodial wallets in Vertalo. So when we take an asset and digitize it and then tokenize it, we spawn and create keyless custodial wallets that do not require the investor to know anything about blockchain, and in fact do not actually have keys. So same thing as accessing a brokerage account. When it comes to compliance with ATSs and the general capital market structure, I'm benefited by one of my co-founders who, when he was a regulator at the SEC, was the lead author on the SEC's concept paper on ATSs. And so we designed our technology around the broker-dealer custody problem and wrote our smart contracts so that we could use a public blockchain and separate concerns in the controller function between broker-dealer's order matching function and the custodial clearing function. So we solved those problems already. We actually also solved the token problem by basically abstracting tokens entirely away, retaining the programmable benefits of tokens, meaning ROFRs and transfer and trade restrictions and tendering and escheatment and rollbacks, all of those things, without having to load them into a very expensive ERC 1400 type token. So I agree with so much that Dan has said. The difference is it doesn't have to be a private network that these run on. And in fact, the SEC and FINRA have no official opinion as to public or private blockchains. They do have one opinion. We're a transfer agent. We're an SEC transfer agent. They don't want the blockchain, especially what we know as blockchains like Ethereum and et cetera, to be the single source of truth yet. They still require a single entry ledger, like a spreadsheet, to be the single source of truth. That will change. But all of the things that Dan is talking about can be accomplished on public chains, and as well as they can on private chains. It's a matter of actually who's working on it. Not every so-called token issuance platform can do what Dan is talking about. And there's a lot of nuance here that Dan appreciates, and the Symbiont team appreciates deeply. A lot of the market doesn't really understand this yet, so including the regulators.
It will be interesting to see how they evolve, given we have fully public chains like Ethereum, as you mentioned, can only go so fast if they have so many validators. Just the literal speed of light limits them. And then you have some of these semi-permissioned, something like a delegated proof of stake. And then you get the fully permissioned where they can operate very quickly. It'll be very fascinating to see how some of these went out.
Let me throw one more thing in here. So we started working with Tezos about a year and a half ago, and we did a head-to-head test just a couple of weeks ago on the cost and speed of confirming a trade on Tezos versus Ethereum. The Ethereum, trading the token on an Ethereum network and gas cost was well over $100. That same suite of smart contracts, just written in Tezos, trading the same asset would cost $11 and also cleared faster. So there's a big difference in gas cost and in speed between public chains, just as there's a big difference between public chain speed and clearing as there is with Symbiont and private chains.
That makes sense. Well, I want to pick up on one thread that Dan was carrying there. He mentioned laws that have developed over 100 years to protect investors. And I generally get a feeling that a lot of people in the crypto space think some of those laws might be outdated or improperly placed. And one of the biggest movements we see right now that is challenging those is the DeFi movement, where we have literal decentralized bucket shops, binary options, lending platforms, all without banking charters or without complying with swap requirements under the CEA, that type. And yet a lot of people identify some of the reasons why those laws came about: price manipulation, solvency risk, asset abandonment, just investor incompetence. And they think that just by moving this on chain, we solve a lot of those problems. At the same time, we still have laws such as the BSA, which you identified, which helps fight criminals, terrorist activity, and other unwanted behavior, which will likely be necessary and useful into the future. So how do you see DeFi and some of these other new movements affecting or evolving to meet traditional financial infrastructure needs? And do you see it going the other way, or do you see DeFi generally disappearing altogether as more permissioned players move in?
I think DeFi is definitely it's an interesting area. There's been a lot of innovation there. It's forcing us to rethink traditional lending structures and workflows. However, one of the things with DeFi, and this is also like an issue within blockchain, DeFi is all about not delegating trust and not delegating responsibility. But as transaction complexity increases, people are more willing to delegate trust and responsibility of some stuff. So outside of blockchain, delegating trust and responsibility is not a big deal. It's for some in the blockchain world, in DeFi specifically, what some people call an intermediary. Other people may see it as a specialist. One man's toll taker is another man's service provider. So it's really like not everybody wants to run nodes and hold custody of their own assets. It's okay to offload some of those things. And I think that DeFi also, it's almost like a victim of its own success. As it grows, then the protocols keep getting forked. So you fail to like keep critical mass. And maybe at some point, one of them is going to evolve to like rule them all. But right now, it's kind of like they just keep attacking each other and offering ever higher yields, which are just cannibalizing each other's like users. And I'm not sure like how high this can go until it's a disaster. But that said, one of their main issues is that by their decentralized nature, they cannot offer proper customer support. And because of that lack of customer support and security and kind of like native insurance, then they're definitely not ready for mass adoption, specifically at the institutional level. There may be some retail adoption to a certain extent, but because of that lack of customer services and UI and like kind of user experience, that's what's holding them back. And then you also have services like Celsius or BlockFi, which are centralized finance like CeFi, which pretty much like took that idea and then wrapped it and made it more accessible. And I think those white glove service approaches are what can get mass adoption, because not everybody is totally against delegating trust and responsibility.
Dave, do you have any thoughts?
Yeah, Vertalo is very deeply involved in DeFi. We're working with Maker Foundation and with Centrifuge to help onboard real world assets and pledge them as collateral against these DeFi networks. Dan brings up a lot of great points. There's a lot of forking, et cetera. This is a whole session that I can't answer in 1 minute. So we've only got a few more minutes. So DeFi is early, and it's going to be big. And Vertalo is spending a lot of time on this.
Gotcha. So from what I've heard from Dave so far, you want to stake Tezos and you want to buy into DeFi. Just kidding.
Oh no, it's these are all cool new products. So why don't we talk about managing ownership on chain? Because I'm not sure that everyone understands why digital securities are so special.
Yeah. So let's go into digital ownership a little bit. This is a discussion about financial data. How can companies leverage blockchain to manage financial data and manage the ownership of data related to digital securities?
So the reason blockchain is a thing, distributed ledger is a thing, is a step function improvement off of single entry ledgers. So up until very recently and still today, most of these centralized ledgers don't express a truth at a point in time, but they don't have a rollback. They don't really have an audit log. They don't have change logs, and there's no immutability there. Blockchain is a fantastic system for cap tables and shareholder registries, because not only is it hard to trick or have a fat finger error when you have machines encoding the ownership, but it's very, very hard to steal things from people when the record is spread out all over the place. And so spreadsheets are a bad place for ownership ledgers. Distributed ledger is a great place for ownership, ledgers of ownership of any kind of asset.
Yeah, Dan, do you have anything?
And I think that blockchains are great for managing data with a single source of truth and the immutable ledger with perfect auditability. I think the key challenge for blockchains is privacy, and particularly that's where we believe that Symbiont has an edge. So unlike other layer 2 or middleware privacy implementations, Assembly, which is the name of Symbiont's platform, has native support at the protocol level, and this ensures like a very robust and highly scalable privacy model. I mean, We also have support for HSMs, hardware security modules, for key management, which also helps satisfy regulatory custody control requirements. This is actually the reason why, and actually, like, I'm happy to hear there's other ones, but as far as I know, the assembly platform is the only blockchain that has been deployed inside the firewall of major banks in their pre-production environments. And all this is because of all this, like, the very robust security and privacy system that goes along with it. Because as mentioned earlier, blockchains are great for openness and transparency, but once you try to put robust privacy on top of it at the protocol level, not on a layer 2 solution, it gets very complicated. And I think that Symbiont has nailed that specific use case of how to have privacy and for these type of applications. And that's why the banks are trusting us.
Yeah, we nailed that ourselves a while ago. It's important not to confuse the concept of blockchains with MetaMask, okay, and with public addresses. So there's no reason why you need to hold a digital security in a public wallet if you have a technology like Vertalo's or Symbionts, where you can fully obscure ownership. We enable people to transfer their securities to self-sovereign wallets, but in fact, the regulators don't love self-sovereign wallets. That's the case in the U.S. and Singapore, and they're not great for privacy. So our system is as private as any brokerage account, and you're absolutely right. That's a problem. Luckily, it can be solved for private and public blockchains.
All right, well, we've got about 1:30 left. So in a very quick soundbite, this is a big question. I want to get your guys' thoughts on it to close us out. What needs to change in the current digital asset infrastructure to bring mass adoption, given that we're already inside the firewalls of major banks, we're already in the public sphere a little bit? When are things really going to change?
I think that there's two things to recognize. And one is that we already have the technology to operate in a fully compliant way with the existing regulation. So that's one. There's some tweaks and some ideally letters of no action that should come out, but we have what it takes to operate in this. And then second, we also need to recognize that traditional players that drive mass adoption, like custodians, should be integrated into the blockchain ecosystem to really bring this to the mainstream.
Gotcha.
Yeah, I agree. We have integrated custodians into the public blockchain ecosystem. They're a necessity in trading private digital securities. That's what the recent SEC no action letter to FINRA said, and it's a clarification on the joint statement on broker dealer custody in July of 2019. So I agree. The thing that we need to make digital securities on blockchain adopted in a mass fashion is better assets on chain, better deals. Direct listings, things like that. Those are, let's get Palantir and Asana on blockchain.
Sorry to cut you off, Dave, but appreciate your thoughts. This is Dave Hendricks with Vertalo and Dan Truque with Symbiont. Have a great day.